Hello people, welcome to the channel Free Management Education. Today we will discuss about risk and uncertainty analysis in financial management, and this is the first part of the series. Here we will discuss about the expected net present value, the variance and standard deviation for risk analysis, the coefficient of variation techniques, and the conventional techniques for risk analysis like payback period, the risk adjusted discount rate, certainty equivalent approach. In the next part, we will discuss about the sensitivity analysis, scenario analysis, decision tree analysis like that. Okay, moving on. Okay, so now we will start the video. Here, risk. What is risk? Risk is something that the investors want to avoid, or sometimes the investors wants to take risk to get a higher monetary value. Okay, so risk exists because of the inability of the decision maker to make perfect forecasts. Risk arises in investment evaluation because we cannot anticipate the occurrence of the possible future events. We do not know what will happen in the future. That's why there is a risk. Okay. There is a risk with certainty, and consequently cannot make any correct prediction about the cash flow sequence. When there is uncertainty about future, we do not know about the correct prediction about the cash flow sequence, whether there is a greater cash flow or lesser cash flow, like that. Okay. A large number of events influence the forecasts, okay, like economic and political conditions in the country, monetary and fiscal policies, social conditions, industry factors like industrial relations in industry, by innovations, by change in material costs, company factors like change in management, strikes, natural disasters, etc. Okay. Now we will understand the expected net present value with an example. Okay. So this is the cash flow, and this is the probability for year 1, and this is for year 2, and this is for year 3. We have to calculate the present value of the expected cash flow using 10% as the discount rate. Okay. Now, this is the formula for ENPV, or expected net present value, where ENCF here, this is the expected net cash flow. This is nothing but the multiplication of the net cash flows multiplied with the probability for each cash flow. Like this 1000 multiplied by 0.1. NCF, or net cash flow, multiplied by the probability of that particular year, of that particular period. That is 1000 into 0.1, 2000 into 0.2, 3000 into 0.3, 4000 into 0.4, like that. Here K is the discount rate and T is the time period. Okay. Now, how do we apply this formula and solve this problem? Okay. Now we have to find the PV, or the present value of the net expected cash flow, that is ENCF, that is expected net cash flow, equal to, we will apply the formula here, that is ENCF by 1 plus K to the power 1, here is also 1, plus ENCF. Now this is the formula, okay, for 3 years. So there are 3 terms here. Okay, so this is the first term, second term, and third term. Okay, for 3 years. So at first you will find the ENCF for year 1, that is 1000 multiplied by 0.1 plus 2000 multiplied by 0.2 plus 3000 multiplied by 0.3. okay, like this. Okay, by 1 plus the discount rate, that is K, that is 10% here, that is 0.1. 10 by 100 is 1 to the power 1. Okay. Now again the same thing for year 2, that is 1000 into 0.2 plus 2000 into 0.3 plus 3000 into 0.4 plus 4000 into 0.1. So this becomes 2400 by 1 plus 0.1 square. Okay. Again 1000 into 0.3, 2000 into 0.4 plus 2000 into 0.2 plus 4000 into 0.1. So this becomes 2100 by 1 plus 0.1 to the power 3. Okay, and this value, this numerator value is 3000. Okay, so just solve it and we will get the answer. Here it will be 3000 into 0.909 like this plus 2400 into, so this is this. Okay, just simplify it, you will find the value, and this becomes rupees 6286.5. So this is the present value of expected cash flow using 10% as the discount rate. Okay, and this is the formula of ENPV. Okay, and ENPV is the expected net present value. ENCF is the expected net cash flow. Okay, expected net cash flow, it is given by net cash flow multiplied by the probabilities. Net cash flows multiplied by this probability. Okay, net cash flow multiplied by this probability. Okay, like this. So expected net present value is sum of the present values of expected net cash flow, because this is the summation sign, right? We are adding, so it is the sum of present values of expected net cash flows. So I hope this is clear to you all. Okay, now we have discussed the expected net present value. Now we will go into variance and standard deviation. They are the absolute measures of risk. Okay, so this is a measure of dispersion of cash flows, which is the difference between the possible cash flows that can occur and their expected value or the mean value, expected or mean value or average value. Here variance measures the deviation about the expected cash flow of each of the possible cash flows. We'll understand this with this example. So just read the lines and understand it. And if you don't, then I will explain it with this example. Standard deviation is the square root of variance. This is the formula, okay, of sigma square, that is the variance, and sigma is the standard deviation. Okay, this is standard deviation and this is variance. Okay, so sigma square is always variance and sigma is the standard deviation. Okay, now we will apply this here. So sigma square, that is the variance, equal to, you can see that it says that the deviation about the expected cash flow of each of the possible cash flow variance in the definition, that is NCF J. J is the the different time periods. J can be 1. When it is 1, then it is this time period. Okay, when it is 2, then again this, 3 this, 4 this, 5 this. Okay, sorry, I have forgot to write this. This is for project X and this is for project Y. Okay, this is for project X, this is for project Y. Okay, now the sigma square equal to, what is our first value in cash flow? 4000, right? Then 4000, that is our net cash flow here. 4000 minus expected net cash flow. What is the average of this? 4000 plus 5000 plus 6000 plus 7000 plus 8000. Okay, it is 30,000 by 5, that is 6000. So our average is 6000. So 4000 minus 6000, that is our expected, this value, expected net cash flow, whole square into the probability. When it was 4000, the probability is 0.1, right? This P, J for the time periods 1, 2, 3, 4, 5. Okay, there are 5 time periods. So that's why it says J equal to 1 to N. Since here is 5 time periods, here N will be 5. Again, next, pause the video and solve it on your own now. 5000 minus 6000 whole square multiplied by, what is the probability here? 0.2, right? So just like that, with dot dot dot, this value becomes the rupees 1,2,0,0,0,0. Okay. Now this is for the project X. Now this is the variance, and now the standard deviation is root over of this formula here, right? 1,2,0,0,0,0,0. So this gives the value of 1095.45. Okay. Same for project Y. Same for project Y, sigma square. So here the average is, if you 12,000 plus 10,000 plus 8,000 plus 6,000 plus 4,000 divided by 5, it is 8,000. So at first 12,000 minus 8,000 multiplied by the probability of first is 0.1. Okay, plus dot 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 dot, like that we'll find the value of rupees 44,000,000, and the sigma is root over what is it? 44,000,000. So that is the value it gives 2097.62. Okay, so this is 1095.45 and this is 2097.62. Okay, so now this calculation of standard deviation clearly shows that this project Y is riskier. It has higher standard deviation. So it is much riskier. Okay, and had the expected net present value of the two projects been same, on the basis of standard deviation we measured the risk here. Okay, so project Y not only has a larger expected net present value but also has a larger standard deviation compared to project X. Project X has a standard deviation of 1095.45. and how do you find the expected net present value? You just cash flow multiplied by probability by 1 plus k, that is the discount rate, to the power the time periods. Okay, I have already explained that in the previous one. So this is it. Okay, now there is a problem. Okay, project Y has a larger expected net present value but also a larger standard deviation as compared to project X. Now we will use a relative term to measure this, to solve this problem. Okay, because variance and standard deviation were absolute measures of risk. Now we will discuss about coefficient of variation, which is relative measure of risk. Okay, I hope this is clear till now. Just pause the video and watch it and solve it on your own. You will understand it better. Okay. Okay, now we will discuss about the coefficient of variation, which is a relative measure of risk. Okay, it is defined as the standard deviation of the probability distribution divided by its expected value or the mean value. Okay, it is a useful measure of risk when we are comparing projects. Okay, when they have same standard deviation but different expected values, or different standard deviation but same expected values, or different standard deviation, different expected values. Okay, so in the previous question we have solved that sigma for project Y, that is the standard deviation for project Y, is 2097.62 and the standard deviation for project X is 1095.45. Okay, now project Y may be preferred because of the larger standard deviation. Okay, but there is a problem. Because of this, it is much more risky as compared to project X, because project X has a smaller standard deviation. Okay, it is more risky, the project Y is more risky as compared to project X. Okay. Now we will find the coefficient of variation to solve this issue. Okay, the coefficient of variation for project X is CV for project X is given by the standard deviation, that is 1095.45 by the expected value or the mean value. So here the mean value, that is we add them and divide them by the number of terms, that is 5, we get 6000. So we get an approximate value of 0.1826. Again, the coefficient of variation of Y is given by 2097.62 divided by 8000. So we get the value of 0.2622. Okay. So these are the different coefficient of variation values. Now, whether the investor will accept the project or reject the project depends on the mindset of the investor. Okay, depends upon the investor's attitude towards risk. If the investor loves to take risk, he would prefer project Y. Okay, because there is a higher expected monetary value. Since there is a larger standard deviation, there is also a probability of higher value, higher expected monetary value. But in case the investor is risk averse, or he or she doesn't like to take risk, he would accept the project X, for it is less risky as it has lesser standard deviation. More standard deviation, more risky, less standard deviation is less risky. Okay, so I hope this is clear up till now. Okay, now comes the conventional risk analysis techniques. At first, the payback. I have made 2 separate videos on capital budgeting techniques where I have discussed all the techniques from NPV, IRR to ARR to payback period, everything. Okay, just go through them in my financial management playlist I have included in the description box. The payback period is the time required to recover the initial cost of an investment. Okay, that is the number of years it would take to get back the initial investment made for the project. Pretty simple. It ignores the time value of money. Okay, you know about the time value of money, how with time the value or the worth of money changes. Okay, like about 40 years ago, rupees 50 was much more in today's day than today's day. Okay, like that. Then comes the risk adjusted discount rate. In an investment, more uncertain the returns in the future, the greater the risk. Obviously, if you are not certain that you will get this amount of money in near future, then there is greater risk of your money getting lost actually in the market. Okay, the more uncertain the returns of the future, the greater the risk and the greater the premium required. What is premium? That is, the investors demand more money, more rate for more amount of money than the normal market rate. So that is the premium, because they are uncertain about the returns in the future, so they demand a greater premium. Okay, so if time preference of money is to be recognized by discounting the estimated future cash flows at some risk-free rate to their present value, okay, then to allow for the riskiness of such future cash flows, a risk premium rate may be added to the risk-free discount rate. Okay, here see this, I have explained this here. Okay, in this bracket, investments must pay a risk premium to compensate investors for the possibility that they may not get their money back, and higher the risk, higher the premium an investor expects over the average return. Okay, that is what I explained. Then what is risk-free rate? Risk-free rate of return represents the interest on an investor's money, okay, that would be expected from an absolutely risk-free investment over a specified period of time. Obviously, this is theoretical. There obviously exists some risk in any investment. So risk-free rate of return represents the interest on the investor's money that would be expected from an absolutely risk-free investment. Okay, pretty simple. Now this is the formula, the rate. This is the risk-free rate and this is the premium. Both are added to get the risk-adjusted discount rate, RADR. Okay. Okay. Now the certainty equivalent. Okay, this is another approach. It is a guaranteed return that someone would accept now rather than taking a chance on a higher but uncertain or risky return later. Okay, that is, someone would want that this amount of money right now than some higher returns in the near future, which is uncertain. Okay, so the investor would like to have his money back, which is certain right now. Okay. For example, if an investor, according to his best estimate, expects a cash flow of rupees 60,000 next year, he will apply an intuitive correction factor and may work with 40,000 to be on the safe side. That is, he expects rupees 60,000 next year, but 40,000 is already there, so he would pick the 40,000 rather than the 60,000 in the next year, because that is uncertain amount, that is not sure. So, but 40,000 is sure, so he would take that. So it is expressed in this NPV formula. Okay, alpha t, alpha suffix t, and NCF, that is the net cash flow. Alpha is the risk adjustment factor or the certainty equivalent factor. I will explain this. Okay, KF is the risk free rate assumed to be constant for all periods, and NCF is the forecast of net cash flow without risk adjustment. So what is the alpha t, or the certainty equivalent coefficient? It assumes a value between 0 and 1 like probability and varies inversely with risk. Higher risk, lower the value of alpha t. Okay, a lower value will be used if greater risk is perceived, and a higher value will be used if lower risk is perceived or anticipated, okay, or guessed. For example, a cash flow of rupees 20,000 may be estimated, but if the investor feels that only 80% of it is a certain amount, only 80% of rupees 20,000 is certain amount, then the certainty equivalent coefficient will be 0.80. That is, he considers only 16,000 as a certain cash flow. 80% of 20,000 is rupees 16,000. That is the certain cash flow that the investor feels that this is the certain amount. 80% is the certain amount. That is, the certainty equivalent coefficient will be 0.80. Okay. Okay, now the difference between the RADR and the CE approach, or the certainty equivalent cash flow approach. This CE approach recognizes risk by adjusting estimated cash flows and employs risk-free rate to discount the adjusted cash flows. Okay, so it employs risk-free rate to discount the adjusted cash flow, but RADR adjusts for risk by adjusting the discount rate. Okay. So CE approach recognizes risk by adjusting estimated cash flow, but RADR adjusts risk by adjusting the discount rate. There is a difference. It adjusts by estimated cash flows and it adjusts for risk by adjusting the discount rate. Okay. Second point, this is not a difference but just a fact. The RADR approach will yield same result as the CE approach if the risk-free rate is constant. Okay, and the RADR is same for all future periods. Okay. Next, the CE approach is superior to RADR approach. The problem with RADR is to select the value of a K. In the formula, we will find a value of K. To select that particular value of K which properly measures the degree of increasing risk, it is difficult to measure such a rate. Okay, so with time the risk changes. It may increase or it may decrease, but for RADR to select that particular value to particular rate, it will increase or decrease. That is much more difficult. But in CE approach, there is the certainty equivalent coefficient, that is alpha t factors. In each period will specify different degrees of risk. Alpha t is the time period for first. Suppose the risk for first period or first year is lower, then alpha t will be adjusted for that particular period. If in the second year the risk is higher, then alpha t will be adjusted for the second period. But RADR, it is not same for the RADR. Okay, you have to select a particular value of K which is constant there. Okay, so this is the difference between the RADR and the certainty equivalent cash flow or CE approach. Okay, so this is the end of this video. So thanks for watching. Please do like, comment and subscribe to this channel for more updates. Okay, and my email ID is given in the description box. Do comment if you want some specific videos on some specific topics. Okay, thank you. Stay safe. Take care of your family.